Purchasing ownership stakes in a publicly traded company is known as investing in stocks. By investing in those small shares, which are referred to as the company's stock, you are expressing your hope that the business will prosper and grow over time. As a result, the value of your shares may rise, and other investors may be willing to pay more for them than you originally paid. This means that if you decide to sell them, you could make money. A decent guideline is to have an expanded venture portfolio and to remain contributed, in any event, when the market has highs and lows. Putting money into an online investment account, which can then be used to invest in shares of stock or stock mutual funds, is one of the best ways for novice investors to learn how to invest in stocks. You can start investing for the price of a single share by opening multiple brokerage accounts. Paper trading is another option offered by some brokers. Before investing any real money, you can use stock market simulators to learn how to buy and sell. 6 steps for investing in stocks. Although there is no one-size-fits-all strategy for investing in stocks, this 6-step procedure may assist you in getting started. Open an account, choose between stocks and funds, establish a budget, focus on the long term, and manage your portfolio are the next steps. First, choose your strategy for investing in the stock market. There are a number of options. Select the option below that most accurately reflects your investment strategy and level of involvement in stock selection. A. I would like to choose my own stocks and stock funds. Continue reading. This article provides a breakdown of essential information for hands-on investors, such as how to compare stock investments and select the appropriate account for your needs. B. I'd like a specialist to handle the process on my behalf. You might be a good candidate for a low-cost investment management service called a robo-advisor. These services, which help you invest your money in accordance with your specific objectives, are offered by virtually all of the major brokerage firms as well as many independent advisors. C. I'd like to start investing in the 401k of my employer. For novice investors, this is one of the most common ways to get started. It teaches novice investors several tried-and-true investment strategies, making little commitments consistently, zeroing in on the long haul and adopting a hands-off strategy. The majority of 401k plans provide access to individual stocks but only a limited selection of stock mutual funds. Second, select an investment account. Once you have decided on a preference, you can begin looking for an investment account. This typically refers to a brokerage account for the hands-on types. Opening an account with a robo-advisor is a good choice for people who need a little help. Below, we break down each process. A crucial point: you can open an account with very little money through brokers and robo-advisors alike. Second, select an investment account. Once you have decided on a preference, you can begin looking for an investment account. This typically refers to a brokerage account for the hands-on types. Opening an account with a robo-advisor is a good choice for people who need a little help. Below, we break down each process. A crucial point: you can open an account with very little money through brokers and robo-advisors alike. The do-it-yourself choice: opening a brokerage account. Most likely, opening an online brokerage account is the quickest and cheapest way to buy stocks, funds, and other investments. If you already have sufficient retirement savings in an employer 401k or other plan, you can open a taxable brokerage account with a broker or an individual retirement account, also known as an IRA. The passive alternative: opening an account with a robo-advisor. A robo-advisor provides the advantages of stock investing without requiring its owner to choose individual investments. Robo-advisor services handle all aspects of investing. During the onboarding process, these businesses will inquire about your investing objectives and then construct a portfolio to meet those objectives. Although the management fees here are typically a fraction of what a human investment manager would charge, this may sound expensive. The majority of robo-advisors take a 0.25% fee from your account balance. If you want, you can also get an IRA from a robo-advisor. Despite the fact that robo-advisors are relatively inexpensive, it is important to carefully consider your provider and read the fine print. A certain amount of cash must be held in an account by some providers. The providers typically charge very little interest on the cash position, which can have a significant negative impact on performance and result in an unfavorable allocation for the investor. Sometimes, these positions requiring cash allocation are higher than 10%. If you decide to open an account with a robo-advisor, you probably don't need to read any further, the rest is only for those who like to do things themselves. Third, learn about the differences between investing in funds and stocks. Don't stress. Investing in stocks need not be difficult. The majority of people invest in the stock market by choosing between the following two types of investments. ETFs or stock mutual funds are two options. You can buy small amounts of a variety of stocks using mutual funds in a single transaction. Mutual funds that track an index include ETFs and index funds. A Standard & Poor's 500 fund, for instance, buys the stock of companies included in that index to replicate it. Additionally, you acquire a small stake in each of these businesses when you invest in a fund. For a diversified portfolio, you can combine several funds. Keep in mind that equity mutual funds are also sometimes referred to as stock mutual funds. Individual securities. You can get your foot in the door of stock trading by purchasing a single share or a number of shares if you have a specific company in mind. It is possible to create a diversified portfolio from a large number of individual stocks, however, this requires significant research and investment. Assuming you go this course, recollect that singular stocks will have highs and lows. If you research a company and decide to invest in it, if jitters start to set in on a bad day, think about why you chose that company in the first place. The fact that stock mutual funds are naturally diversified lowers your risk is one advantage. For by far most of financial backers, especially the individuals who are effective money management their retirement reserve funds, a portfolio comprised of generally shared reserves is the reasonable decision. However, mutual funds are unlikely to soar as quickly as individual stocks. While it is possible to earn a lot of money from individual stocks if you make an educated decision, it is extremely unlikely. Fourth, during this step of the process, new investors frequently have two questions about their stock market investments. How much cash do I need to begin stock investing? The price of the shares determines how much you need to spend to buy a single stock. From a few dollars to a few $1,000s, share prices can vary. On the off chance that you need common assets and have a little financial plan, a trade exchanged reserve, ETF, might be your smartest choice. ETFs, on the other hand, trade like stocks, so you can purchase them for a share price, in some cases, less than $100, while mutual funds typically have minimums of $1,000 or more. How much should I put into stock investments? Have we mentioned that the majority of financial advisors prefer investing through funds? If you have a long time horizon, you can put a significant portion of your portfolio into stock funds. When saving for retirement, a 30-year-old might invest 80% of their portfolio in stock funds, the remaining funds would be bonds. Another story concerns individual stocks. Keep these to a small portion of your investment portfolio as a general rule. Fifth, concentrate on long-term investing. Stock market investments have proven to be one of the best ways to build wealth over time. The annual stock market return is approximately 10% over several decades. However, keep in mind that is only an average for the entire market. Individual stock returns will vary, and there will be ups and downs in some years. For long-haul financial backers, the securities exchange is a wise speculation regardless of what's going on every day or year to year. They are seeking that long-term average. After you start investing in stocks or mutual funds, the best thing to do might be the hardest: avoid looking at them. It's a good idea to avoid the habit of obsessively checking how your stocks are doing several times a day. every day, unless you're trying to beat the odds and win at day trading. Sixth, manage your stock portfolio while worrying about fluctuations on a daily basis won't do much for your own health or the health of your portfolio. There will undoubtedly be times when you will need to check in on your investments or stocks. If you follow the above steps to buy mutual funds and individual stocks over time, you should check on your portfolio several times a year to see if it still meets your investment objectives. This usually means using funds to make up the majority of your portfolio. Warren Buffett is famous for saying that the best investment most Americans can make is a low-cost S&P 500 ETF. You should only choose individual stocks if you think the company can grow for a long time. The S&P 500 is an index of approximately 500 of the largest publicly traded companies in the United States. Over the course of the past 50 years, its average annual return has roughly matched that of the market as a whole, which is approximately 10%. The bottom line for stock investing. Deciding which investment strategy to pursue, which type of account to open, and how much money to invest in stocks is really all that is required. For newcomers, learning how to invest in stocks can be intimidating.